What's up guys, in today's video we're going to be talking about how to invest during 2021. Well, in reality it doesn't matter what year it is, because in today's video I'm going to share with you guys some timeless wisdom from one of the best investors to ever walk the planet, Warren Buffett. The Oracle of Omaha has accumulated a net worth over his lifetime of $87.5 billion. So if you're going to listen to anybody when it comes down to investing, Warren Buffett is probably going to be your guy. And not only that, but I feel like it's probably worthwhile making a video on perhaps some more grounded investing principles, let's say. Especially driven by the fact that over the course of the past 2 weeks, we've seen a little bit more irrational investing behavior, which to be honest guys, I do fear is going to lose a lot of people a hell of a lot of money. So let's dive into it. But before I do so guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a like on the video guys. It really helps out the channel. And with that being said, let's dive straight into it. So Warren Buffett, one of the most famous investors on the planet, not just famous for some of his investing wisdom over time, but also his execution too. It's meant that over the course of the past few decades or so, Warren Buffett has accumulated tens of billions of dollars, along with others who have also studied Warren Buffett who have probably gone on to make a hell of a lot of money too. And some of the most infamous quotes from Warren Buffett really do capture much of his investing philosophies. The first one being, never invest into a business that you cannot understand. Second, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And third, the stock market is a device for transferring money from the impatient to the patient. So let's dive into those quotes in a little bit more detail. By firstly talking about only investing in the things in which you actually understand.
We will never buy anything we don't think we understand. And our definition of understanding is thinking that we have a reasonable probability of being able to assess where the business will be in 10 years. The only way we know how to make money is to try and evaluate businesses. And if we can't evaluate a carbon steel company, we don't buy it. It doesn't mean it isn't a good buy. It doesn't mean it isn't selling for a fraction of its worth. It just means that we don't know how to evaluate it.
It's a really super important element of investing to actually try and consider what the future value of a company is going to be in 10 years from now. And if you don't have kind of some idea of the future value of that company in the future, well, you probably don't know quite enough about that business. When I'm investing, I'm not just simply looking at the price of a stock and then investing based on its performance over the course of the past month, 3 months, 6 months, or 12 months. In fact, I go a hell of a lot more deeper than that, and I do look at the underlying fundamentals of that business. Now, in order to value a stock and to understand whether it's actually a good investment or not, you can do something called fundamental analysis. Now, fundamental analysis is a method of measuring a security's intrinsic value by examining related economic and financial factors. Fundamental analysts study anything that can affect the security's value, from macroeconomic factors such as the state of the economy and the industry conditions to the microeconomic factors like the effectiveness of the company's management. So let's break this down into both macro and micro factors. At a macro level, the key things in which I'm looking at are global, political, and economic factors. When we think about global factors, I'm thinking about what does the world need and does the business align to fundamentally meet that need. Then we think about the political factors. What is the president or the prime minister's political focuses, and where are they investing their government money? Thirdly, we're going to think about the economic factors. Is the economic sector in which you're investing into a growing or an up and coming sector, or is it a sector that's currently in decline? And just to throw this out there, the macroeconomic factors are one of the most important things to consider when you're looking at growth stock investing. Then we have the micro factors, where you're going to be looking at both qualitative and quantitative analysis. And this is more for the value investors out there. So you've got the qualitative factors such as the strategic direction in which that business is going in. You've then got the company's leadership to consider and the caliber of leaders at the top of that organization, as well as board members too. You've then got the probably more familiar quantitative factors. So you've got things like the price to earnings ratio, the price to sales ratio, price to book ratio, sales growth, earnings growth, current ratios, and much more. This is the kind of in-depth analysis that Warren Buffett fundamentally expects that you have completed in order to truly know what you're actually investing into. And the chances are, guys, if you've done all of this due diligence and you've done all of this additional analysis on the actual stock in which you're investing into, the chances are you'll have a hell of a lot more of an understanding of that business once it's being completed. And when you compile all of that information together, you've probably also got a better idea on the likely success of that company at some point in the future. So on the subject of future success, let's talk about a quote in which Warren Buffett made in his 1996 chairman's letter to his shareholders. He says, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Put put together a portfolio of companies whose aggregate earnings march upward over the years, and so also will the portfolio's market value. Look, I think for any investor out there, this is a really important concept to understand. You can invest into a stock on any given day, and the following day that stock may go down in price. The last thing that you guys want is to actually feel uneasy by the prospect that the price of the equity in which you've invested into could potentially go down before it goes up. And that's why it's so important not to focus on short time horizons when you're fundamentally a long-term investor. Let's just take a look at the realities of investing in the stock market as a whole for a moment. If you look at the S&P 500, for example, it's an upward trending chart, which means that over the course of the long term, it has consistently increased in value when we look at it from that longer term time horizon. And in actual fact, over the course of the past 100 years, the average rate of return is just shy of 10% per year. But another important thing to consider here is that investing returns haven't always come easy. As an example, if you'd have invested in the early 2000s at the height of the dot-com bubble, up until about 2007, you'd have barely broke even on your investment. Forget about not wanting to hold a stock for 10 minutes for a moment, because you could have received absolutely zero return on investment from investing for 7 whole years. But then again, if you'd held on to that investment for the next 13 consecutive years thereafter, your total rate of return would have run up to just shy of 160%. And do bear in mind that doesn't account for any reinvested dividends, along with acknowledging the fact that this was probably the worst time to invest over the course of the past 20 years. But despite all of that, your portfolio still would have grown at a compounded annual growth rate over the course of the past 20 years of 7.9%, which certainly isn't too bad whatsoever, considering the fact that you would have invested at the very height of the dot-com bubble. And that's why it's so important to have patience when we're investing into the stock market, as Warren Buffett has expressed in so many different interviews over the course of the past few years. And look guys, I appreciate returns like this of just 7.9% per year might not float everybody's boat who are currently watching this video. Some of you guys no doubt will be looking for hyper growth stocks that are looking to grow, 100% return on investment over the course of the next 12 months. But I hope nonetheless that this provides a grounded picture on just what's possible, even at the very, very basic level of investing, if you're simply just prepared to see it out for the long term. So talking about being patient, Warren Buffett has also been quoted saying, "The stock market is a device for transferring money from the impatient to the patient." And I feel like Warren Buffett sums it up pretty well in this interview, albeit in a rather blunt fashion.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes
selling
down?
a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, "I'll pay you 15," you don't sell it because the quote's 15. You look at the house or whatever it may be. Some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become.
If you don't have the right discipline and the right mindset when you're investing into the stock market, you're probably going to get burned. To try and bring this quote to life a little bit, investors who are impatient in the market are more likely to sell their stocks as the price of the stock declines, and then try and buy back that same stock once it starts to recover and the price starts to increase. Those investors will sell their shares to the likes of Warren Buffett, who is looking for a great deal in the market. The likes of Warren Buffett will happily take those shares off your hands, and then he will wait. He'll wait 5, 10, 15 plus years or so in order for that stock to recover, or even just continue on its overall long-term upward trajectory. Buffett will then capitalize on all of the upside gains that the impatient investor lost out on. This is why Warren Buffett also recommends that for the average person, they should stay away from the kind of active investing approach. And instead, this is what he recommends for the everyday individual.
On March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war, and that America would progress as it has ever since 1776. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be.
So as Buffett says, the average investor should simply just buy into a low-cost index fund and hold it for a long period of time. And for the majority of people, that's the strategy for investing success. Because in actual fact, this strategy alone, just investing into the market and tracking the overall market average, will actually outperform 89% of fund managers who do this professionally for a living. So I do very much hope that this video has brought you guys a little bit of investing wisdom from one of the best in the business in the midst of all of this craziness in the stock market over the course of the past couple of weeks. Be sure to let me know, guys, what some of your favorite investing quotes are down in the comment section below too. And as always, guys, if you did enjoy the video, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.